Thank you so much for joining us today for this RightTraining session on an in-depth overview of asset return assumptions. I'm really excited to walk through this topic with you because return assumptions play such a central role in every financial plan. They impact our projections, the Monte Carlo outcomes, tax calculations, portfolio growth, and ultimately the conversations you're going to have with your clients. In today's session, we're going to take a deep dive into several key areas. We'll explore the different preset assumption models available in RightCapital, including our historical index returns and our forward-looking assumptions. We'll break down how inflation assumptions work both at the global and client level. We'll discuss how return model assumptions affect our Monte Carlo engine, and we'll also take a look at some of the more advanced features like custom asset classes and correlation controls. So by the end of the webinar, my goal is for you to feel comfortable and confident in navigating each section and understanding how these settings influence your planning outcomes. A couple of quick housekeeping notes before we begin. This webinar is being recorded and you will receive a copy of the recording after the webinar is complete. And then we'll also have some time at the end for a live Q&A. So feel free to throw any questions you have into the Q&A box down below. And at the end, I'll make time to cover any questions you might have. With all of that, though, let's get started. So for anyone who's not familiar, asset return assumptions are going to be the baseline assumptions about how various asset classes will perform over time, their expected returns, like interest, dividends, and capital gains, as well as volatility and growth. These assumptions are going to underpin almost every investment projection in RightCapital, cash flow projections, Monte Carlo simulation, like I mentioned, our retirement analysis tab, tax projections, and more. So because of that, setting accurate asset return assumptions is critical. They're going to influence that long-term growth, portfolio outcomes, and our probability of success. In RightCapital, you can set and manage these assumptions at the global level from here in the advisor portal. In order to access them, we're going to select the More menu, or these three dots in the upper corner here, and then we're going to click on Assumptions, and that's going to put us on our Asset Returns page. The global assumptions you see here are going to become the default starting point for all new plans moving forward. So from here, you can use the RightCapital defaults, which we'll go through, or you can utilize some customized return assumptions as well, which we'll also touch on. Let's start with the foundation of return modeling in RightCapital with historical index returns. So when you first open up this tab, as you click on here, you'll notice that we have these two options between historical and forward-looking assumptions. The default setting for any RightCapital plan when you first sign up with us is going to be historical index returns. That's what you get out of the box. This is the preset that most advisors use, and it is curated directly by our RightCapital team here. These assumptions are built using geometric returns sourced from major market indices, and we do update them every single year to reflect the latest available historical data. So the product team is in there. As the turn of the year is coming up soon, our product team is aware of changes that might need to be made, and they will be working on that early Q1. For our equity asset classes, so you'll notice here we have our asset categories that are broken up, and then we have the individual asset classes that belong to each of the asset categories. So for our equity asset classes, things like our large cap, emerging markets, we're going to look back over the past 50 years of available return data. If an index doesn't have a full 50-year history, we're going to take it as far back as we can and use the full data set that's available. So this is just going to help ensure that the assumptions are as robust as possible while also staying true to the historical performance of each asset class. Now, for the more fixed income categories, we're going to use a slightly shorter window, typically the last 20 years of available data. Many fixed income indices don't have decades and decades of history behind them, so using a 20-year sample gives us a consistent, reliable data set to pull from. All of this data, like I said, is refreshed annually. And for those who want to see the actual values behind each asset class, we do actually include a breakdown of the historical index returns and the indices within our Help Center. So just to show you where to find that information, really quickly, I'm just going to click on my chat feature in the bottom corner, and that brings me to my Help Center, or I can select Help in the upper banner here, and let me just find my historical index returns. So searching the Help Center is pretty convenient to find my historical index return assumptions. And then scrolling down here is going to be the table for the index and time frame used for each individual asset class. So this is broken out for you within our Help Center if you want to take a deeper look into all the different numbers that we're coming up with here. Fantastic. So that is historical index returns, again, the RightCapital default when you sign up with us. We also here can talk about the forward-looking assumptions, and these presets are built, or this preset is built using the data from JP Morgan's Long-Term Capital Market Assumptions report. These are JP Morgan's forward-looking expectations for long-term returns, volatility, and correlations across the major asset classes. Just like our historical return assumptions, the forward-looking assumptions are also updated each year by our product team. So whenever JP Morgan publishes their new capital market assumptions, our product team is adjusting those within RightCapital for you. This option can be especially helpful for advisors who prefer a more research-driven or expectation-based approach rather than relying solely on those historical long-term averages. And then when you select the forward-looking preset, the plan will automatically apply the return and risk assumptions throughout the entire plan. So if we wanted to, instead of using the historical index returns, utilize forward-looking to make that the global setting, all you have to do is select forward-looking, and then we'll set the global setting down here in the bottom. If we do make this change, it's going to just give you a warning here that says once we make this change, it is going to override the assumptions for clients that are already using the global assumptions setting. So just important to pay attention if you are making changes to the assumptions on this global level in the advisor portal, you will end up impacting some client plans if you're making a deviation from the norm here. So just something to pay attention to on that front. We also have a Help Center article that breaks down these assumptions as well in further detail if you want to really take a deep dive. And that's going to be very similar to our Help Center where we search for historical looking assumptions. We have our JP Morgan forward looking assumptions here, with our chart below summarizing the information here by asset class, interest, dividend, and capital gain information, and our total return. And then we also have a link to that JP Morgan report as well, if you want direct access to the report that we are utilizing here. And again, that's all in the Help Center for you. Let me close that tab. Excellent. So those are the two pre-built return assumption sets for a RightCapital plan. Now, you do have the ability to create your own custom return assumption sets within RightCapital. So we can see here this nice blue button, pretty straightforward, lets us know that we can make new return assumptions. Now, this is a bit of a newer update. Previously in RightCapital, you had one opportunity or one set of customized return assumptions that you could create and customize. Now we have the ability for you to create as many as you like. So if you are going to create a new return assumption set, you'll just click on the button here. It's going to give us a completely fresh set of asset classes, and all of the interest, dividend, and capital gain blocks are available for us to change. Once we do go ahead and make the changes here, for example, if I just put in some super simple return examples here, if my computer will let me, we'll hit save. That's going to then become available for you to apply this either as the global setting or implement it within a specific client plan. You also can name these return assumptions by clicking on the title. It'll open up the text box for you to title this whatever is most convenient for you to keep track of your return assumptions. Just be sure to hit this check mark so the name saves. And then you also can click the three dots in a circle to make a copy of any return assumptions that you've created. You could also rename it, and this is how you're going to delete any items as well if you happen to have an old maybe return assumption set that you want to get rid of in the system here. You also, I should mention, you can copy the forward-looking and historical index returns. So if you want to work off of what we have already in the system and make adjustments on your own, you can create a copy in this case, and that's going to populate for you down here in order to make a copy and manipulate the specific items here as well. So a lot of um, control, I would say, versus the previous update where we didn't have the flexibility to create multiple return assumption sets. Now, some things to consider. I want to wrap this section up by talking through a few important things to really think about when you're choosing your asset return assumptions. Asset return assumptions, again, are going to play a major role in every financial plan. They are going to influence projected investment growth, Monte Carlo tax calculation. So it's good practice if you are creating your own return assumptions to periodically review and update any custom return assumptions that you've created to make sure that the plan aligns with current expectations. Now, talking about historical indexed returns, these are going to operate on the idea that long-term historical performance can provide a reasonable insight to future behavior. So this method is going to use evidence based on data pulled directly from market index history, creating systematic and consistent foundation for your financial plans. On the other hand, with our forward-looking assumptions, these rely only partially on that historical market data. They're going to incorporate expert research and broader macroeconomic factors. So this approach introduces a bit more subjectivity, but it does reflect a more modern, expectations-driven way of thinking about long-term returns. So from a practical standpoint, you'll typically notice that the historical index returns is a little bit more optimistic than the forward-looking preset. When you apply historical assumptions, most plans are going to show a bit of a higher probability of success. And when you switch to forward-looking assumptions, that probability often decreases in a client plan. Neither approach is right or wrong. They simply just reflect different philosophies and different expectations about future market behavior. So take all of that into account. Maybe rewatch the webinar after, just digest that information, and then make the decision that's most relevant for you and your client's financial situation. A little bit later on in the webinar, I will go into a client plan and show you how to implement these custom return assumptions within a specific client plan, as well as where within the client plan our return assumptions make the most impact. But that'll be a little bit later on. For the now, let's dive in and talk a little bit more about our inflation assumptions now. RightCapital is going to utilize 5 different inflation assumptions to project goals, expenses, and other future cash flow items. You'll notice I just clicked on the next tab over from asset return to inflation. So that's going to bring us to, again, these are global inflation settings that are going to impact all client plans if we do make these changes. There are 5 inflation types here. The first one being general inflation, then healthcare, education, social security, and tax. Specific data entry items within RightCapital are going to inflate according to these different inflation assumptions. For general inflation, this is going to adjust living expenses, general goals, and most standard cash flow items like expenses, savings, and incomes that have annual increase tied to the general inflation data entry field here. Let me dive quickly into a client plan and just show you what I'm talking about specifically for anybody who might not be familiar. So within a client plan, let me just open up a sample here. When you're doing specific data entry within the profile tab for the current plan, things like goals for expenses example are going to have inflation tied to them. In this case, a spending strategy for retirement expenses is going to be inflation adjusted. So that is going to follow the inflation assumptions set by general inflation. If you do set a goal, for example, like a vacation goal, if you notice this annual increase field here, if your card is set to general inflation, it'll inflate with the general inflation assumption that's in the assumptions. Anytime you set this to be different than general inflation, we can either tie it to the health inflation assumption, the education inflation assumption, or something customized. So just something to pay attention to. Any cards, depending on how we indicate this annual increase, can be tied to one of the different inflation assumptions available to us in the advisor portal in the global settings. I just wanted to point that out for anybody who wasn't sure what I meant when I mentioned that annual increase field. So again, general inflation is going to adjust living expenses, general goals, and most standard cash flow items. Healthcare cost inflation is going to be used obviously for health-related costs such as retirement healthcare expenses and long-term care cost projections, as well as any expense or goal tagged with that healthcare inflation in that annual increase field. Education costs are going to cover pre-college and college goals. Social Security is going to be the inflation rate that adjusts future Social Security payments and also affects Social Security related thresholds such as the primary insurance amount, taxable wage base, and any other indexed values tied to Social Security. And then lastly here, tax inflation. This is used to inflate tax-related thresholds over time, contribution limits for retirement accounts, as well as ordinary income and capital gains tax brackets. We have all this information listed out in the Help Center as well. I can understand that was a mouthful. For more information, you can always click on this link right at the bottom here that conveniently brings you to inflation rates within RightCapital and gives you a nice breakdown of each of the different inflation types and what different cards are affected by them. So we do have this available for you in RightCapital. I know I said a lot, so we do have resources if anybody needs them. Excellent. Now, again, a little bit later on in the webinar, I will go into a client plan and show you how to adjust these on a client by client basis. So again, these are out in the advisor portal on the global level, but you can indicate differences within a specific client plan and customize the inflation assumptions on a client by client basis as well. At the bottom of the tab here, there is a checkbox for different inflation timing of these future items. If you check a box here, we can control goals, income, savings, or expenses. If you check a box, any plan items with a future start date, for example, if you were planning a vacation 10 years from now, this goal will be inflated from today until the start date. So if you have this box checked and you have a goal set for 10 years in the future, RightCapital will apply inflation so that way the value of that vacation in 10 years from now is inflated based on the inflation assumptions in the settings here. If the box is not checked, future items will not automatically inflate between now and their start date. This means that the amount you enter stays at the face value until the start date. No right or wrong answer here again, but I will note that if you do leave it unchecked, we could underestimate some future costs, especially if you're in a high inflation environment. So just something to pay attention to again. If you are going to uncheck these boxes that we're not going to be inflating these items for the future, something to just pay attention to, understating that potential expense there. Now, just some other things to consider with inflation assumptions and why they matter. They're going to drive how fast a client's expenses, goals, and Social Security benefits grow over time. Underestimating inflation can significantly skew long-term projections. So the numbers that you plug in here, if you are using custom ones, could have a large impact on your client plans. Another thing to consider is by using different inflation rates for different expense types, you can get a more realistic, nuanced projection that aligns better with real-world cost dynamics, especially in categories like healthcare or education, which historically grow faster than general inflation. Using global defaults is simple and efficient for most clients, but for clients with special needs, we will touch on customizing those on a client-by-client basis to make an individual client plan that more accurate. Excellent. So that is all inflation information. Again, resources in the Help Center for which cards are specifically impacted by each type of inflation, as well as our ability to inflate these goals for the future. The last large assumptions tab here is going to be our miscellaneous assumptions. I also want to take some time to talk about the different options we have here. This is going to help us fine-tune things like real estate transactions and maybe adjustments upon the death of a co-client here. Pretty straightforward, where the cost of purchasing a real estate property just represents typical closing costs, fees, and other costs associated with buying real estate. On the other side of it, the cost of selling a real estate property, any real estate agent fees or costs associated with selling a real estate property. And then this expense adjustment upon the death of a co-client is representing an expected reduction in living expenses after one spouse passes away. So it is going to affect the pre-retirement and retirement living expenses within joint client plans. If it's a single client plan, this setting is not going to have an impact on a single client plan. But on a joint client plan, we will see a reduction if one of the clients were to pass away before the other. We will see a reduction in the living expenses entered in our pre-retirement and retirement expenses card. Just below this now are our return model assumptions. These settings are going to really impact the engine that drives the Monte Carlo calculations in RightCapital. So they're going to influence how volatility is modeled, how returns are calculated, and ultimately how realistic your probability of success results will be. Because of their broader impact, these are only going to be assumptions available on the global level. All the other assumptions, asset return, inflation, and miscellaneous of these three up above are going to be editable on a client by client level, but our return model assumptions are only for the global setting. So if you adjust these, they are going to impact every client plan you have in your system. The first setting in this section is going to be the model type. This is determining how the Monte Carlo simulation generates market volatility year over year. And we offer two different models, legacy and standard. Legacy is going to use a stochastic volatility framework. Big mouthful for a Friday, but a stochastic volatility framework, and it accounts for the correlation between asset classes and the relationship between returns and overall market volatility. Advisors who joined RightCapital earlier, I believe February 3rd, 2023 was when this update came out. We rolled out the standard model. This legacy model was the original Monte Carlo calc engine. So for users who joined RightCapital in 2023, early February, and before, legacy is the default setting here. But for anybody who joined afterward, standard is now the new default when it comes to this model type setting. Speaking of the standard model, this is going to use a log normal distribution, so a more traditional approach that's seen widely across the financial industry. The main advantage of the standard model is that it offers greater flexibility when setting asset return and volatility assumptions. It's also the required model for using any of RightCapital's preset return assumptions, such as those historical and forward-looking assumptions that we talked about earlier. So if you do happen to utilize the legacy model, you're not going to have the options here to select between using historical and forward-looking assumptions. You have to be on the standard model type in order to have control over choosing if you want to use one of the two different asset return assumption sets that are pre-built within the system. You can switch between models at any time. I should also say that. There's no time frame that you're unable to switch. You can make that adjustment whenever you'd like, but I will say again, it will impact your entire book of business entered within RightCapital. Down below, we also have the calculation type. This is going to control how the Monte Carlo computes future asset returns. So you can choose between geometric and arithmetic calculations. The geometric method uses the geometric mean, which reflects the effect of compounding over time. This is widely considered the industry standard for long-term portfolio performance. It's also the default in RightCapital. And regardless of your selection, the baseline projection will always use geometric returns. And that baseline projection is going to be that baseline scenario within the scenarios under the models tab. Now, the arithmetic method uses the arithmetic mean, which is a simple average of annual return. Because arithmetic averages can overstate a long-term performance, RightCapital does adjust these returns by subtracting half of the asset's variance to reflect volatility drag. Also a mouthful for a Friday afternoon, but even with that adjustment, arithmetic calculations typically produce a higher projected return and therefore often lead to a higher probability of success in the Monte Carlo. Again, not to say one is right and one is wrong, but just something to note. Arithmetic might lead to a higher probability of success than if we were to use the geometric calculation type. Now, again, this setting is going to update across all client plans. I know that was probably a mouthful for some of us, so if we do ever want to dive deeper into all of that detail within the different calculation types and how they're going to directly impact our Monte Carlo, we can always click on the link to the Help Center. It's going to bring us to the miscellaneous assumptions page. It'll talk about the 3 assumptions that we mentioned earlier, as well as the different return model assumptions. So we can see here our stochastic volatility model for legacy, log normal distribution for standard, and it breaks this all out, as well as the calculation type. So there's some additional information here if you want that. And then, of course, you can always contact the support team if you want even more detail behind the scenes of the calculation engine within RightCapital. Excellent. Now, a common question we hear as well is, do you need to adjust your return model assumptions? A lot of advisors oftentimes are curious if this is something that would be maybe a recommendation to change. So just to kind of touch on that point as well, the honest answer would be no. It's not a requirement to change any of these settings. The default combination of the standard model with the geometric calculations does provide a robust industry-aligned results suitable for the vast majority of financial plans. That being said, the flexibility is there for advisors who want to tailor volatility modeling or explore different methodologies based on their firm's philosophy or investment outlook. So up to you if you want to make that adjustment. The defaults are great for a financial plan in the vast majority of cases. However, you do have that flexibility. But excellent. So that was a deep dive of the return assumptions, inflation assumptions, and miscellaneous assumptions within the system. I also want to take a moment to highlight a little bit more of an advanced feature within our return assumptions framework, and that's actually going to be custom asset classes. This is a tool that is designed for firms that need additional flexibility beyond our standard asset class list, allowing you to better reflect some maybe proprietary models or unique investment strategies within your firm. Let me pause my screen share here and jump into a different RightCapital account that does have this feature enabled. Give me just a moment here to pull this up. Alrighty. Now, with custom asset classes enabled, advisors can expand the existing structure of asset categories and tailor return assumptions in a more granular way. You'll have the ability to add new asset classes. And then once those asset classes are created, those custom asset classes, you can also define their correlations to all of the other asset classes as well. And I'll go into that in more detail in just a minute. In addition to customizing correlations, you can also adjust volatility assumptions for default and custom asset classes, giving you complete control over how these assets behave. It's also important to note that this custom asset classes feature is an advanced feature. At this time, it is only available to firms in our Platinum subscription tier. If you're not currently on Platinum, but feel that this level of customization would benefit your planning process, our sales team can help you explore upgrade options to get that enabled for you. There are also a few nuances to be aware of before enabling this functionality, so definitely something to pay attention to when you are talking to a sales rep about turning on custom asset classes, but once they are turned on, they cannot be turned off within the system based on how it's configured in the back end. So again, just something to pay attention to. Once we do make that step to turn it on, we cannot turn it off in the future for your plan. So we always encourage advisors to just take a moment to really evaluate whether this is truly the level of customization that aligns with their workflow and planning needs. Alrighty, let's see here. So I also want to preface, I just want to make sure I'm covering all my bases on these custom asset classes here. When they are enabled, we do use a different model to generate Monte Carlo scenarios. This is to account for the flexibility provided for updating volatility and correlation assumptions. This granular approach is going to utilize a standard log normal distribution model. So if you do enable custom asset classes and maybe you're on a legacy model for that calculation type, you might see different results for your existing plans. But I think that is come to be expected, especially if we are adjusting the different volatilities, correlations, and the asset classes themselves. Now that I've said all of that, let's actually show you what that looks like. So when your firm does have asset class functionality fully enabled, let's go into how to add and configure new asset classes. Asset classes, custom asset classes is going to be something that is visible for the super admin of the firm. So you're going to have the admin tab enabled under either the more menu, under the three dots item, or along the top banner here. Depending on what items you have enabled on your RightCapital subscription, it could be in two different places, but regardless of where it is, the functionality is the same. Once you're in the admin tab, we'll go ahead and click on our assumptions tab. This is going to be our return assumptions. You're going to find the asset class tab. Here, we're going to see all of the asset classes listed within RightCapital. And then you also have the ability to create your own asset class. So you'll click add. It'll give you the option to select which asset category we want to add the asset class to. You can add it under the ones that are available here, or if it doesn't happen to fit into any of the ones that are listed out, you can click other. It's going to allow you to title this asset class. Once you hit save, you can then apply this asset class to accounts within your portfolio or model portfolios, and you can set the assumptions for that asset class. So I have this one set here. I just called it title so we can keep track of it. We can go back to our return assumptions, new return assumptions. And if we scroll down here, there are a couple that have been created already within this sample plan, but my title return assumption is here for me to adjust dividend, capital gain, and volatility information for this new asset class that I've created. You also have the ability to adjust the volatility for any other return assumption sets you've created as well, not just brand new ones that you've clicked on. Excellent, excellent. Some common use cases for our uh, other asset classes, a really helpful pro tip that I like to recommend to a lot of advisors using the custom asset classes feature is actually going to be using custom asset classes to create a general cryptocurrency asset class. A lot of our advisors ask if we account for items like cryptocurrency. In this case, RightCapital default does not, but asset classes allow you to create your own. In this case, you can create either a general overall cryptocurrency asset class or even dedicated asset class for specific cryptocurrencies, maybe like Bitcoin or Ether. Regardless, totally up to you how you want to configure these specific custom asset classes. Now, once you do create your custom asset classes, you've assigned return assumptions to each of them, then your return assumptions will be available for all the advisors in your firm to utilize if you do utilize that team sharing feature. And then you also will be able to apply them to your specific client plans. Again, I'll go into applying them to client plans in a moment or so here. But the other functionality with custom asset classes, not only can you create them and apply them to your client plans with your own custom return assumptions, but once your firm has enabled custom asset classes, you can also find a correlation matrix listing out all the standard asset classes as well as any custom ones that you've entered as well. For each overall asset category, you can manually set the correlation value. The correlation value determines how closely returns move together. A high positive correlation means that the asset classes tend to move in the same direction. A low or a negative correlation means that they tend to move inversely to each other. Why does this matter? Customizing correlation assumptions is especially important when you're modeling non-traditional assets or alternative investments, for example, like private equity, commodities, hedge funds, or even a firm managed strategy. If you treat all assets as if they have the default correlation within the market, you could understate the diversification benefits or misstate correlated risks. So always great to come in here and just play around with the correlation matrix and ensure that everything is set up to your planning philosophy. This is going to lead to more realistic projections and help you build better informed advice. So again, three different options within our custom asset classes feature. Creating the asset class, assigning the asset class a return assumption, applying it to a client plan, and then full control over the correlation between asset categories within the correlation tab here. Now, I've talked about doing this all on the global level here. That's going to impact all of our client plans, but let's talk about a client plan that might deviate from the norm or adjusting this on a client by client basis. Allow me to just pause my screen share one more time, dive into a client plan, and I will show you where these assumptions are going to impact within a client plan as well as how to adjust them inside of a client plan. Excellent. Alrighty, so diving into this client plan here, I just want to head right over to my gear icon in the upper corner and then settings. And I can tell I'm in a client plan because the client name is displaying in the upper corner for me. Now, if I scroll down here a little bit, I'm going to find under my settings tab, my return assumptions. Now, RightCapital is going to use the global assumptions first here. And then we have, if you click on the drop down, the global assumptions. Oh, I guess this plan is already deviating from the norm, but a default plan will utilize global assumptions that you have set. And then you can select from using either one of the two. If the historical index return is the global assumption, then that will be the same impact here. And then you can switch to forward looking, or you can switch to one of the ones that you've created, as well as completely household specific. So let me preface that one more time. You created custom return assumption sets over in the advisor portal. I created one that's just named to differentiate as well as that copy that I showed you. So these are available for us to adjust. And then we also have household specific. So if you want to get just fully custom on a one client plan, you'll use the household specific assumptions. And then from here, you'll notice interest, dividend, and capital gain information is available for you to manipulate. Once you make all your changes, you can go ahead and hit save, and that's going to apply them to the client plan. Same thing of if you just select one of the ones that you've created, we can go ahead and make that selection and it will be applied to this client plan. And that's how we apply those return assumptions. Now, the inflation assumptions can be found in the other assumptions tab here. We have our 5 inflation rates that are using the global assumptions for general education, tax, healthcare, and social security. We can select from global to customized and use a completely customized assumption for this client plan. Once you go through and make your selections, you'll just hit save at the bottom to make sure those changes are saved. That will then impact the adjustment made to this client plan. And then just below that as well, our miscellaneous assumptions are found here too. Now remember, in that miscellaneous assumptions tab, we had our return model type calculations as well. Those settings are only on the global level, so we're not going to see them here. We're just going to see the 3 miscellaneous assumptions that are associated with the cost of purchasing and selling real estate, as well as that expense adjustment upon the death of a co-client. Again, click from global to customized, make your adjustment, and then hit save. Once we do make these selections, I just want to point out some areas in the software that the asset allocation or the return assumptions are going to impact. The first one being asset allocation. So if I scroll up to the top here, I just want to bring you to my investment tab, and then my asset allocation tab is here. So if you are utilizing different return assumptions that are tied to the different asset classes, you can make those adjustments either on a global level or on a client level. And then within the asset allocation tab, you can, if you are creating your own models, or if you're using the RightCapital default models, you can utilize this tab to compare a RightCapital portfolio to the client's current allocation. So maybe if we're looking at making a recommendation from how the clients are allocated currently using RightCapital default models, and then maybe you have custom asset classes and have created your own portfolio, or you've created your own separate model portfolio, not using custom asset classes, but just creating it your own. You can plug it into this area and compare the two different portfolios here. The action items down below are going to give us a roadmap of what asset categories we would need to manipulate in order to get from one portfolio to the target portfolio. And again, the target portfolio or the target allocation is the one that we've selected on the right here. So this is one area that we're going to notice our asset classes or our model portfolios that we've created. The other area in the software is going to be under retirement. Under the retirement tab, we have let me scroll down here. I have a lot of changes in this plan here, but if we scroll down, we have this asset allocation this asset allocation action item. This is going to be the other area in the software where you can actually propose a model portfolio to your client plan. So again, the current plan will use the current allocation, which is based on the allocation of the accounts over in profile net worth. And then you can utilize this action item to propose a new portfolio or a new allocation for this client plan. And then we can see what that impact is on the probability of success and the Monte Carlo calculation. Allow me to reset my action items here to see if I can. Oh man, this is not a great sample plan. Let me pull up a different sample plan here that will allow me to kind of showcase to you just making that change in the action items. Let's see here. Retirement. Perfect. Let's scroll down here. So we have our current allocation for this plan, and then we can make an adjustment to maybe a more aggressive portfolio here, and we can see in real time what this looks like. So our median ending portfolio value went up, and our probability of success went down. So just to explain what's kind of happening here, typically in this case, we are increasing our risk of market exposure. So when we're running the Monte Carlo calculation, there's additional volatility, there's return scenarios that are random. They are taking more risk on by having a more aggressive portfolio. So by that nature, it's going to lower the probability of success as again, they're more exposed to market downfall. The median ending portfolio value went up, however, because the return assumptions are higher. So we are seeing a little bit more growth on the accounts, which is going to end in a higher ending portfolio value. Now, just to refresh anybody's memory, the median ending portfolio value is not the value that the clients are guaranteed to end up with at the end of the plan. This is just a representation of trial 500 of the 1,000 Monte Carlo trials that are being done on the back end calculation. So, the median ending portfolio value went up. Not to say that the clients are going to end up with that specific amount. However, it's just saying by this calculation and a more aggressive portfolio, we are seeing the potential for higher returns, and we're representing the range of trials by trial 500. And again, the confidence tab is going to be a better way to visualize those 1,000 Monte Carlo trials, showing us the range of possibilities as we navigate throughout the planning horizon here. So just wanted to refresh anybody on why we were seeing that specific impact in this case. Perfect. And then the last area, so we did our asset allocation adjustment here. The last area that we are going to really see the impact of our asset returns as well, in terms of just manipulating the software, would be within the profile tab. When you are allocating investment accounts, for example, I'll just open up this taxable account. We have it being based off of our model portfolio. You can either utilize a model portfolio, again, in the system, one that you've created or one that we have here for you, or you can use a fully customized value here, and the asset classes are available for you to adjust. And of course, the returns on each of these asset classes are based on the assumptions that we had just gone over for the majority of this webinar. So just wanted to indicate that this is where we can allocate the accounts and actually put the return assumptions within to a client's current plan.